Hi, it's Kevin here once again from Spread Select. Welcome to this short presentation on the Spread Select trading process. Trading is a multi-step process and we're going to look at it on a step-by-step basis. There are decisions at every step of the process. These decisions are based on information from the market and the application of your system's rules. This information must be managed and must be accessible. We identify 9 steps in this process. We must identify the overall strategy and which markets we're going to trade. We must find the trends, assess the trends for strength and risk, identify setups and management plans for any trades we should take. We identify entry points, triggers and conditions that would lead to entry before we consider an entry. We set the risk parameters. Only then we undertake the trade. Once in a trade we must manage the trade, and finally we should keep records and monitor our performance. The first step is fairly straightforward as it only has to be done once. This is to decide our overall strategy. At Spread Select, this is a trend following strategy, so we concentrate on markets that trend best, such as Forex, commodities and stock market index. We aim to catch the middle of the trend. We don't trade when we think there's going to be a trend or when the trend is getting very advanced. We wait for confirmation. Sometimes we don't trade. If volatility suddenly spikes, we pull back from the market. We exit trades if we think that there would be a trend break. When we don't trade for sometimes days at a time. We trade around the trend. In other words, we don't stay in a trade too long. We get out when we think there's a pullback, because even the strongest trends have pullbacks. We can always get back in later. And remember, a trend may end, but might not reverse. So sometimes we get out of a trend and we don't necessarily trade that item again for a period until a new trend is confirmed. The second step is to find a trend. Not surprising, this is very important given that we have a trend following strategy and we will only trade with a trend. We apply 5 templates to each market at both daily and weekly levels to assess which markets are trending. These templates are mostly based on moving averages, but we also require confirmation by a number of indicators. 2 of these templates are fairly fast moving, 2 are slow moving and 1 is intermediate. By having this mixture, we aim to catch changes in the trend fairly quickly, but we try to limit whipsaws. This is always a balance to be found. If you have a very sensitive template, then you're going to get whipsawed. If you don't, then you could be trading with a trend that has ended. The results are then weighted and aggregated into the term. This is discussed in the video on the home page of this site. The third step is to assess the trend, as not all the trends are the same. The term model assesses the strength of the trend and assesses if the weekly trend supports the daily. The daily trend conclusion, in other words, is there a trend, is it strong enough, is the basis for any decision on whether or not to trade or whether or not even to analyse the market further. If there is not a good daily trend, we don't trade. It's as simple as that. On the other hand, if the trend is present but is overly extended, or if indicators diverge, indicating that the risk of any trade in that trend is too great, then we will not trade. We've also got a particular setup for divergence, and we can adopt that if we wish to enter that market. Step 4 is to identify setups. Setups help us manage the information, and also help us then to manage the trade, should we take one. We have 6 predefined setups for different situations and different market conditions. Each setup has criteria that must be met before a trade is considered. Each also has a set of rules that show how the trade will be managed. Each setup specifies the entry conditions or trigger points that will cause us to enter a trade, how the risk parameters for that trade are to be set, how the trade will be managed in terms of time horizon and risk control, and finally it indicates the exit conditions, although it does not tell us the precise exit level. These are all rules, they don't vary, so the setup is automatically identified by the term. Step 5 is to identify an appropriate entry point. This is a timing issue. However, timing is set not at a particular date, but when certain conditions are met. Just because there's a trend does not mean we will trade. We need to find an appropriate entry point. Once a setup is identified, we have to analyse the market further using hourly data in order to time the entry as well as we can. After all, most of our trades are probably less than a week. Therefore, we need to get the timing right. These conditions are set in the setup rules. There is some discretion here, but it is largely rule-based. We use standard indicators such as the MACD, RSI and Williams %R. But these must be used in a manner that is appropriate for a trending market. The way in which these are applied and the conclusions that are drawn is different with a trend following strategy than with other types of market analysis. The overriding question at this stage is not to look for a trade. We already see where the opportunities lie from our term analysis. Instead, can you find a reason not to take the trade? By doing so and approaching the market in this way, we avoid confirmation bias. Step 6 is to control our risk. These parameters are set before entering a trade. Remember that your exposure to risk is the only thing in the market that you can control, so make sure you control it. We need to control it initially at the time of entry. We do this by setting our initial stop size level, and we trade the appropriate position size to keep our risk within the predefined levels. The second element of risk control is to identify the target. This is not a hard set target. Instead, it's a level to which we can reasonably expect the market to move given our analysis. When we have done so, we must then calculate our risk-reward level for this trade. Is it appropriate? One further thing I look at is to try to avoid trading before there is a major news or data release. Very often such releases are accompanied by extreme levels of volatility. These often imply risk and our stops can easily be hit. So don't trade before major news, and even consider exiting existing trades if a major news item is upcoming. Once you've done all this, if everything is as you want it, now you can enter the trade. That's step 7, and that's all I have to say on entering the trade. Once in the trade, the next stage is that we must manage the trade. Make sure you know exactly why you entered the trade. The answer to this is that it's fulfilled certain setup criteria. Consider exiting if these conditions of the market mean that this has now changed. We must control our risk according to rules once in profit. Move the stop in the direction of the trade. Which target you adopt is much more flexible. We can move the target either further on to prolong the trade, or we might exit well in advance. It all depends on how the market performs. The rules identify a number of reasons why we might exit a trade, such as that indicators have changed, no longer support staying with the trade. It might be very close to a weekend, and sometimes we like to exit trades before the weekend. There may be upcoming news, or there may be a range of other reasons. The final stage is then to keep good records. It's essential to know why and when you enter the trade to help you to manage it. Furthermore, as we build up a number of trades, we want to calculate what's our profitability. How much do our results deviate? We don't want too much deviation, in other words, big losses or big gains. We want to keep them steady and consistent. What is our overall risk reward? How many trades, what percentage are successful? And so on. Have some targets for these metrics. This will depend on your own personal preferences and see how you are meeting these targets. If you are making mistakes, and particularly if these mistakes are repeated a number of times, good records will help you identify these, and you can then think how these might be addressed. This may require some adjustments to the model. The model, after all, is not set in stone. There has to be some flexibility. However, we don't make reactive changes in the sense that just because one trade does not work, that we therefore think, well, we must change the model. Instead, we consider, should we make adjustments, what these are, and assess what impact these may have, perhaps by having a few trial runs. That's a brief overview of our model. There's a lot more at spreadselect.com. You can also sign up for membership or further seminars. Thanks for watching, and good luck in your trading.